We are back, and this is the 4th episode in my monthly EX Dividend series. And in this one, we're going to be covering stocks that are going ex dividend in the month of September. Now, as usual, I want to say that I'm not a financial advisor, and the stocks mentioned in this video are not necessarily recommendations. You should always do your own research before investing into the stock market. Now, we have another 8 companies for you today, and that's going to be a mixture of the UK's Ftse100 and the US S&P500. Now, if you want me to continue to do this monthly series, please hit the like and subscribe to my channel. It helps me out, and it really is appreciated. So, without further ado, let's get into it. So the first company up on this list is Admiral Group, and that is Epic code ADM. This is in the Ftse100. And it's basically a car insurance company or travel insurance company as well. And it's got a nice dividend yield of 4.16%. And we can see the share price is currently trading at around about £26 per share. And obviously this is the maximum graph. It has been growing and growing over the years. This is all the way back from 2012. And the 1 year graph, you know, we're just not far off here really of all-time highs. All-time highs was around about £27 per share. So we're not far off that. It has been performing very well. According to analysts, though, it is overvalued at the moment by 13%. The PE ratio is at 18, so that's not too bad. That's pretty much in line with the industry as well, just maybe a slightly bit higher. It's got a predicted future return on equity of 41.8% in the next 3 years, so that is very, very good. And we can go into its debt to assets here. It's 88% debt to assets, so it's quite high with a debt to equity ratio as well of 61.3%, so it's not too bad. However, the balance sheet in general is actually pretty good for this company. It'll be paying out around about 91 pence per share, and it's got a payout ratio of 66%. It's going ex-dividend on the 3rd of September, and it will be paying out on the 2nd of October. So my second company up on this list is a very solid dividend payer, and that is ticker symbol PEP, PepsiCo. Now PepsiCo is going ex-dividend on the 3rd of September, and it will be paying out the same month on the 30th of September. It has a dividend yield of 3%, which is going to pay out around about $1 per share, just over $1 per share. Now PepsiCo, as you can see here from the graph dating back to 2013, it has been growing and growing year after year, and it's, you know, not massively far off the highs of $147 per share. It's currently at $138 per share. If we look at the year's graph, it obviously dropped off massively around about March time, and now it has recovered, and it's been kind of trading fairly sideways-ish ever since. Now, according to analysts, Pepsi is actually undervalued by 7%. And it has a nice predicted future return on equity of 62.6% in the next 3 years, which is very, very good. Now, Pepsi has a nice profit there of 10%. It has decreased since 2018, but it nevertheless is still getting that nice little profit there, 10.89%. The debt to assets is slightly higher though, 81.18%, and the debt to equity is even higher, 357% debt to equity. I mean, not all debt is bad, as we know, and Pepsi is a massive growing company and they are reinvesting, therefore they're probably going to take on a lot more debt. The dividend has been paid out for the last 10 plus years, and it has been growing each year as well. It has a payout ratio of 79%. So this company is considered a very solid dividend payer. A lot of people invest into Pepsi because it has been growing, it's shown nice growth, and it has been paying that dividend year after year. My third company on this list is very similar to Pepsi, another solid dividend payer, and that is ticker symbol KO, Coca-Cola. Now, Coca-Cola is going ex-dividend on the 14th of September, and it will be paying out on the 1st of October. It's currently got a dividend yield of 3.41%, and that's going to work out around about 41 cents per share. And similar to Pepsi, it has been growing and growing year after year. As you can see, slight dips here and there, but on average this has been growing very nicely. It's had a massive drop off since February and then slowly started to recover, currently trading at $48 per share. And according to analysts, this is actually undervalued by 8.5%. The PE ratio is 22, So that is actually pretty good for a company of this size. And it has a predicted future return on equity of 56.2%, which is very nice indeed. And we can see here the profit as well. The profit margin has been growing from, you can look at 2018, 2019. It has been growing year after year. Now it's on 23.94% profit margin, which is very nice to see. And the debt to assets is obviously slightly high again in this industry, and that is 78%, with a debt to equity of 272%. So the debt, once again, is fairly high, but it reinvests it, and Coca-Cola own lots and lots of different products. It's been growing and paying out dividend for the past 10 plus years, and the payout ratio is 76%. Coca-Cola is a very solid dividend payer. A lot of people love Coca-Cola as part of their dividend portfolio. Now, my fourth company up on this list is another stock in the S&P 500, ticker symbol PSA, Public Storage. Now, Public Storage is a REIT, which stands for Real Estate Investment Trust, and it basically owns and operates self-storage facilities. It's going ex-dividend on the 14th of September, and it'll be paying out on the 30th of September. It's got a dividend yield of 3.84%, paying out $2 per share. So it's got a nice dividend yield there. And we can see the 1 year graph. It hasn't been doing amazing. It has dropped off like most companies, and it's currently trading at $211 per share. So it's a fairly expensive one, this one, but it has got a nice future return on equity predicted of 24.5% in the next 3 years. Now, if we look at some of its financials here, we can see the profit margin is very nice, actually 53.41% profit margin, which is very good to see. And debt to assets is also very low there, 20%. So in general, it's looking quite good in terms of its financials. The debt to equity for this one is also 25.9%, so that's pretty good as well. It's actually, according to analysts, undervalued by 7%. It's been growing and increasing its dividend for the last 10 plus years. Now, the payout ratio is quite high, it's 89%, but for a real estate investment trust, that is actually pretty good going, because they have to pay out a specific amount in the form of dividends. So my fifth company up on this list is in the Ftse 100, and that is Epic code ITRK Intertek. Now, Intertek is basically a quality assurance company focusing on risk assessing and the safety of different products. And it's actually going ex-dividend on the 17th of September, and it will be paying out on the 8th of October. It's got a dividend yield of 1.78%, which is going to work out around about 34 pence per share. Now, we look at its 1 year graph here. Actually, it's pretty much recovered to where it was before pre-crash levels, and it's currently trading at £59.50 per share. It's pretty much recovered. 61 would be its all-time high, so it's not far off that. If we look at its maximum graph, it has very nice growth. We can see this graph going up and up and up, and now, like I say, it's not far off those all-time highs. However, even at this price, according to analysts, it is 75% overvalued. That's according to analysts. And we can look at the PE here. The PE is actually 29.32, which is quite high compared to the market and the industry of 16.4. So it's a very high PE ratio. It does have a nice future return on equity predicted to be 26.8%, which is good to see. And look at its profit margin, 10% profit margin there, and a 66% debt to assets. That's not too bad. The debt to equity is 84% in this company. Now, it's been paying out that dividend for the last 10 years and been growing it, and the payout ratio is 64%, so it's quite a good payout ratio. The only thing with this one, really, it is considered pretty overvalued at the moment at being 75%, and the future growth of 12% is not as high as some other companies out there. However, it has been a very solid dividend payer in the Ftse 100. Now, the sixth company up on this list is ticker symbol CB, and that is Chubb. So Chubb, ticker symbol CB, is going ex-dividend on the 17th of September. It'll be paying out on the 9th of October, and it's going to be paying out a dividend yield of 2.51%, which is going to be about 0.78 cents per share. Now, Chubb is it's in the insurance sector, and it provides a whole range of different insurance and products. And if we look at its current share price, it's $127, and it's once again a very nice growth. This is from 2011, growing and growing and growing, and it's obviously crashed off in February time, started to slowly recover, and now it's at $127 per share. According to analysts, that price is slightly undervalued at just 2.5%. It has a predicted future growth of 41.8%, which is massive, a very nice future growth in the next 3 years, with a future return on equity being 8.7%. So not the highest return on equity, but the growth of 41% is very nice indeed. Now, if we look at its financials here, we can see it's got a debt to assets there of 68.73%, but debt to equity is very low as well, with just 33%. So its financials look fairly good actually, and it's been growing that dividend and paying it out for the last 10 plus years, and the payout ratio is only 63%. So it does seem like a nice dividend paying company right here. That is Chubb. On to number 7, and this is one that I covered a little while ago actually, and this is ticker symbol DTE. That's DTE Energy. DTE Energy, the clues in the name, it's an energy company, and it's going ex-dividend on the 18th of September, paying out on the 15th of October. It's got a nice dividend yield of 3.5%, which is going to get you just over $1 per share. And once again, a very nice looking graph, growing and growing year after year, and it's currently trading at $117 per share. However, at that price, according to analysts, it is overvalued by 25%. The PE ratio is 18, which is pretty much in line with the market and the industry. It has a predicted future growth of 6.9%, so not the most exciting future growth. However, nevertheless, at least it is going upwards and it's going in the right direction. And we see here the debt to assets 72%, so it's fairly high debt, and it has a very high debt to equity of 159%. However, it has been paying out that dividend and growing it year after year for the past 10 plus years, with a payout ratio again of just 63%. So it's got a nice payout ratio, and the growth over the last few years has been pretty good. On to my last company on this list, and this is one in the Ftse100, EPIC code HL, Hargreaves Lansdown. So Hargreaves Lansdown, like I said, is in the Ftse100, and it's basically an investment service. You can use them, you can buy shares, you can buy stocks, etc. And it's going ex-dividend on the 24th of September, paying out on the 16th of October. It's going to be paying out a dividend yield of 2.23%, which is roughly about 43.5 pence per share. Now we can see the maximum graph here. It has done pretty well since 2012, growing and growing. However, for the 1 year graph, we are down about 15% at the moment. It obviously crashed off in January, February time, and it has started to recover fairly nicely. At its current price of £16, it is considered overvalued by 72%. So very high valuation there according to analysts. The future growth is also predicted to be negative, -2%, so that is not amazing. However, the future return on equity is considered to be 39%, which is very good. Now, the one thing I really do like about this company is its balance sheet, its financials. It's been making a very nice profit year after year, and it's currently at a 56% profit margin. And wait for it, the debt to assets is 56%, and the debt to equity is 0. It has 0 debt. And a very good balance sheet. The payout for this dividend yield as well is 57%. So it's quite a nice payout ratio. That's Hargreaves Lansdown. So there we are. That's 8 companies there going ex-dividend in September. And as you can imagine, there are a lot more going ex-dividends. I've just picked a collection here of some of the more popular ones. And let me know in the comments below if you hold any of these companies already, or maybe you're looking to add some more to your portfolio. I appreciate if you hit a like and subscribe to my channel. It helps my channel to grow and helps get these videos out to more people. And as always, thanks for watching, and until next time,